As freight brokers, understanding and verifying a motor carrier's certificate of insurance is not just a best practice, it's a necessity. This becomes especially critical when considering the auto liability section of a certificate of insurance, or COI for short. In this video, we'll dive into the significance of verifying a motor carrier's COI, the risks of not doing so, and the particular challenges associated with certain types of coverage. Thanks for checking out the Freight 360 YouTube channel. I'm Nate Cross, and today we're going to talk about verifying a motor carrier's insurance policy. Please take a moment to like, subscribe, and hit the bell icon so YouTube can get us in front of more people just like you. And please check out the sponsors in the description box to help support this channel. And if you'd like to learn more about Freight 360 and our training, please check out the Freight Broker Basics course using the link below. It's a self-paced program taught by us that covers everything, including how to start your own brokerage, land new customers, grow your business, and even hire the right employees. When you're verifying a motor carrier's insurance, you'll often see a copy of their ACORD 25 form. An ACORD 25 form is a standard document used in the insurance industry, particularly in the United States. It's known as the Certificate of Liability Insurance form. This form provides proof of insurance and summarizes the key aspects and conditions of a specific policy. Today, we're going to look specifically at the auto liability section. The auto liability section outlines the coverage related to vehicles used in the course of a business's operations. It will list the total combined coverage for each accident, as well as limits for both bodily injury per person and per accident. And finally, it'll also give you limits for the property damage per accident. This section is particularly relevant in industries like trucking and freight brokerage, where the use of vehicles is essential to the business activities. So let's start by breaking down the different types of auto liability coverage. First up is any auto. This coverage is the broadest as it includes any vehicle used for the business, regardless of ownership. It'll cover vehicles that are owned, leased, hired, borrowed, or just used by the business in general. For example, a trucking company owns several trucks. They lease a few more, and occasionally they rent additional trucks during peak periods. The any auto coverage would ensure that all of these vehicles are covered under this policy. Next is owned autos only. This coverage is limited to vehicles that are owned by this business. It does not extend out to any leased, hired, or borrowed vehicles. For example, if a freight company owns a fleet of 10 trucks, the owned autos only coverage would insure only these 10 trucks and not any other vehicles, even if the company temporarily uses rented or leased trucks. Next, we've got hired autos only. Now, this policy covers vehicles that the company hires, rents, or borrows, but doesn't actually own. It's essentially for companies that don't own any of their own vehicles, but instead they lease or rent them. For example, a trucking company doesn't own any of its own vehicles, but it frequently rents or leases trucks for freight transportation. The hired autos only coverage would ensure that those rented or leased trucks are covered. Next is scheduled autos. This coverage is for specific vehicles listed or scheduled on the policy. Each vehicle is individually described, and coverage is restricted to those specific vehicles that are listed. For example, a trucking company has a specific list of trucks, each with its own details like make, model, and VIN number, all listed on the insurance policy. The scheduled autos coverage would apply only to those trucks listed in that section of the policy. Non-owned autos is next. This covers vehicles that are not owned, leased, or hired by the business, but they're used in connection with the business. This typically includes employees' personal vehicles used for business purposes. For example, an employee of a company uses their personal car to visit customers and perform business tasks. The non-owned autos coverage would ensure that that personal vehicle is covered when used for business-related activities. For freight brokers, verifying a motor carrier's COI is critical for several reasons. First, compliance and liability mitigation. Ensuring that a carrier has adequate and appropriate insurance coverage helps in complying with industry regulations and mitigating potential liabilities. Then there's protecting the business interests. Verifying a COI helps in understanding the extent of the coverage and any potential gaps, protecting your shipper's interests. Then there's building trust with your shippers. Demonstrating due diligence in verifying the COIs will help you build trust with your shippers, showcasing a commitment to safety and reliability as their freight broker. Now let's look at some of the risks. Failing to verify the COI can lead to a bunch of significant risks. First is claims, specifically uncovered claims. If an incident occurs and the carrier's insurance does not cover that specific scenario or specific vehicle, the claim will likely be denied by the carrier's insurance, and that financial burden could fall on your customer or even you as the broker. Then there's the legal repercussions. Freight brokers could face legal challenges if they knowingly use a carrier that has inadequate or inappropriate insurance coverage. Then there's reputation damage. If you're working with an improperly insured carrier, it can damage your reputation, affecting future business opportunities with other shippers out in the industry. Now, let's look at a special consideration specifically on the scheduled autos coverage. The scheduled autos box on the ACORD 25 form, it warrants special attention. This coverage only applies to vehicles specifically listed by VIN number on that policy. Now, if a freight broker contracts a carrier that only has the scheduled autos coverage, but the vehicle used isn't listed, that vehicle's not covered. So if you use websites like Highway and other various carrier vetting tools, they'll alert you if a carrier has a vehicle that's been inspected, but wasn't actually listed on that scheduled autos policy. This situation presents a significant risk. First is liability exposure. In the event of an accident, if the vehicle's not covered, the financial and legal burden could inadvertently fall on the shipper or even you as the freight broker. You've got shipper relationships. Failure to ensure proper coverage can lead to dissatisfied customers, especially if their cargo's involved in an accident with an uninsured vehicle. There's operational disruptions. Dealing with incidents involving uninsured vehicles can cause a ton of operational delays, which means additional costs typically for you and your business. So, to sum it all up, as a freight broker, it is your responsibility to thoroughly understand and verify the insurance coverage of every motor carrier that you work with. Paying close attention to the type of auto liability coverage, especially that scheduled autos section, is extremely critical. This due diligence doesn't only protect your business, but it also upholds the safety and reliability standards of our industry. Remember, an informed and proactive freight broker is a smart freight broker, and that's just one way to set yourself apart from your competition. Thanks for watching. Let us know what you think in the comments down below, and we'll see you in the next video.